This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all for your support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 179. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Save the date. We have announced our next virtual conference, the SNN Network Summer Virtual Event, which will be held on August 17 through 19, 2021. The website is now live, and you can find full details on the event at conference.snn.network. Registration is open, so when you go to the website, click the register button, and you'll be updated on everything when we announce speakers, sponsors, presenting companies, the works. So again, the website is conference.snn.network. I'll see you all there. For this episode of the Planet MicroCap Podcast, I spoke with Dominique Mielle. She is the author of the upcoming book, Damsel in Distressed: My Life in the Golden Age of Hedge Funds, which will be coming out on September 7, 2021. Dominique's upcoming book is a memoir about her time working at Canyon Partners, which at the time was a small, little-known hedge fund. And over the span of 2 decades, she rose to the top of the firm as the only female partner and senior portfolio manager at a firm in what became one of the largest hedge funds in the U.S. We have a great conversation about her time working at Canyon Partners and all the lessons that she learned along the way. Thank you again for tuning in to episode 179 of the Planet MicroCap Podcast, and please enjoy my conversation with Dominique Mielle. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is a very special guest, Dominique Mielle. She is the author of the upcoming book, Damsel in Distressed: My Life in the Golden Age of Hedge Funds. We're going to learn all about distressed investing, bankruptcy investing, hedge funds, a great story. I'm very excited to have her here. So Dominique, thank you so much for joining me today. How are you doing?
Thank you, Bob. Thank you for having me. I'm great.
It's great to have you. Where are you based? Are you based in France?
I'm in Los Angeles. Usually today I'm in Santa Barbara.
You're my neighbor. What are we doing this? What are we doing this via
We
Zoom?
could have done this physically then.
Man, we really dropped the ball for a lot of people. This is a shame. But you know what? Hey, we're doing this via Zoom. But Santa Barbara, that's nice. It's beautiful this weekend. We're very blessed.
Gorgeous.
All right. Well, I was introduced to you because I heard you do an interview on a couple other pods before, and because the book isn't out yet. It's coming out in September.
The book is coming out September 7th, actually. Yep.
September 7th. Very good. So we're doing the pre-book tour.
Exactly.
Very good. All right. Well, again, thank you for joining us on here as part of the pre-book tour. And so, I'd love to get your full background. My first question I usually always start with is, let's start with your background. Where did your passion for investing begin?
Wow, I'm probably going to disappoint you because it came late in life, at least compared to the legends of hedge funds that you hear about or you read about who started trading lemonades, when they were in high school. But I was born and raised in France. And after college, I figured I wanted to see the world. And the best opportunity I had was in banking in New York. And so I had no particular interest in finance at all, but I figured New York would be a good place to live in. And that's what I did. And I stayed. I became an investment banker for Lehman Brothers for a couple years. They transferred me to the LA office. As you know, and I've written an article about it, the life of an analyst in an investment bank is, the quality of life is not one of the top priorities of that particular job. So after 2.5 years of that, I went to business school. And that's when I really discovered an interest in investing and a real taste for being on the buy side is through 2 classes, one of which was taught by Bill Sharp, Nobel Prize and inventor of the Sharpe ratio. So after that, I joined a teeny little hedge fund called Canyon Capital. There were 6 guys, literally 6 guys in an office that was probably half the size of a regular conference room. They were in LA. I wanted to be in LA. They hired me as an oddball, woman in a men's world, French at that. And it was the only job I had after business school. I stayed 20 years. And when I retired in 2018, that was it. That was my entire career. So, I basically grew up with the hedge fund business because it was a small industry at the time, relatively unknown. I don't think the public would have known what you meant if you said you worked. Certainly my friends and social acquaintances had no idea what I did.
Listen, you were in LA saying you're in finance. Okay. That is that right there. Like,
that's weird as a start.
Okay.
That's weird as a start. And then, I work in a hedge fund, which for most people, frankly, had to do with landscaping, right? It was like cutting hedges and everything. So I spent my time at parties thinking what a loser I am for the better part of the first 6 months.
Oh, that's so funny. I can so relate to that experience. Saying you have some kind of finance job while living in LA. It's end of conversation right there. Not recently. And now they just ask you about crypto, but usually
right.
It's just end of conversation.
Right. So it was a very secretive type of industry, very scrappy, with a lot of very intense people. So that hasn't changed, but virtually everything else has in terms of size and scale and, ability to operate discreetly, secretly, have very special opportunities and distinct competitive advantages. I think, as with every maturing industry, it becomes very hard to outperform. And that's certainly something that I noted in the last years of my career.
Did you feel a culture shock at all? I mean, look, you grew up in France. You're coming now to work in general in the U.S., but in particular in finance. I mean, it's what was that culture? I'm just assuming there was.
It was, yes, because I had worked at large institutions. One was the very first one for a year was a French bank, and then the second was Lehman Brothers, which was a very large institution. So coming to work for a small, almost like it wasn't quite a startup because they had started in 91 and I joined in 98, but it certainly felt like it. It was a shock, but then again, everything was new. So it's sort of, I like to say, look, I could have worked with Teletubbies and I would have thought that's great. That, let me figure out how to get along with them. It was an adventure. It was a place where I could see myself growing and the place and the shop with it. But yeah, it was, there was no privacy. We were all in a conference room where you could hear everybody's conversation. This was before cell phones. So you actually had to make personal calls if you had to make any right there on the trading floor. And it was, an open book, really.
So let's dig into that. Okay, so it's 1998, fresh off coming from business. Where'd you go to business school, by the way?
Stanford.
Okay. I figured it was Stanford or UCLA. I would assume, LA. I did Pepperdine, but at that time, I mean, it was.
That's right. I saw that. Yeah.
Yeah, but it really, I mean, it was Stanford or UCLA are usually the calling cards and stuff.
Right.
But Pepperdine, we're making a name. But take us back. That first day or those first 6 months. What was it like? What was that learning curve for you?
98 was interesting. I interviewed early 98 and the firm had about $1 billion in assets, which was a large, very, very consequent number at the time. On my first day in September, the Dow Jones dropped some 600 points. And that was probably the largest loss in the one-day trading session. What was later called the Asian flu had started. And that was a global crisis that started in Thailand, but really quickly spread out to all, Southeast Asian countries with severe devaluation of their currencies. Then the Russian crisis piled on with Russia declaring a moratorium on its debt. And then on top of that, long-term capital, the largest hedge fund at the time, most reputable, was hemorrhaging cash. So it was a full-on crisis the first few days I arrived, and the $1 billion in assets that I had, studiously written down in my notes for the job interview, I heard that we had 500 million. And I was so naive and so happy to be there that I thought, there's probably a typo when I wrote down $1 billion. I meant a 500, but what does it matter? It's all good. 500 million is plenty of money. So I was genuinely, in the best mood, positively delighted to start my job. And it was the partners and the other few guys, I mean, there were 5 or 6 guys, were shell-shocked by the amplitude of the crisis. I mean, this was 2008 in terms of the scale it had on investors. So it was sort of, we were in save the firm type of mode. Assets were either cut in half because we had some emerging market exposure, or people were taking out their money. So it was survival, really. Wow. And that went on for the first, I can't remember, 6 months, 8 months, until things stabilized. But it was an interesting entry into the business.
So what did they have you do? Like, what, you're just starting out, things are going to hell. They
told me, hey, why don't you look at this company? And I think the first company I looked at was a Brazilian company. I think it was or Mexican. It was either Cemex or Pemex. I didn't know anything. I didn't know left from right. I was a banking analyst. I could balance a balance sheet on an Excel spreadsheet, meaning it doesn't tell you whether you should buy a bond or not, or a distressed situation. I didn't know any. So it took, I would say, the better part of 3 years for me to sort of come into my own, and instead of looking at other people's ideas and sort of building models for them and solidify their thesis to actually have an opinion on my own. The what happened is really the 2001 crisis, and I'm going from crisis to crisis because in this, it's kind of what you're looking for, right? When there's a crisis, there are bankruptcies, there are stressed and distressed assets, there's a lot of damage and rumbles, and that's what you do. You just go through it hoping for a little diamond in the rough. Very much, I imagine what people do when they invest in microcap, right? There's a ton of garbage.
The
and
hair
you spot, right?
The more hair, the better sometimes, it keeps people away, but it allows you to take your time to, really assess if this is something that you want to sink your teeth into. No,
exactly.
Totally.
So 2001 started with the dot-com bust, and that was not so fruitful for us because it was mostly equity caps that were tanking. But then the telecom crisis, which got a lot less press in the media, that was a full-on disaster. That was the time when cable was put to the ground, wireless companies were laying networks, and all this was financed with leverage at a very, very rapid pace, thinking that customers would come. And of course, it's always the same story. The investments are enormous, and then there's a little bit of lag to get the revenue and the cash flow from customers. And that just triggered an enormous loss of value at bankruptcies. I mean, I think that was you can't minimize the scale of that disaster. Of, I think the telecom index plunged 90%. So it was sort of a boot camp. They were, you could think of Global Crossing, WorldCom, Covad, every single, and those names would probably say nothing to you because they simply don't exist anymore. But every cable company, internet provider, wireless, tower companies, they all filed. So there was so much to look at that I really, I got up every morning and had a fresh batch of stuff. And on top of the telecom crisis, it was the time when corporate malfeasance was rampant. This was before SOX. So before the financials were signed by the CEO, the CFO. And so you had very large bankruptcies. Enron, WorldCom, Conseco, Tyco Electronics, you're talking hundreds of billions of dollars of distressed assets. That's the sort of supply versus a demand on the hedge fund side and distressed side that was small. There was probably, I don't know, 500 billion in assets managed by hedge funds. So it was, it was a case where it was a giant buffet of distressed.
Wow. So, I mean, take me back to that time then. I mean, you already have. But when you're assessing all these various opportunities, what were some of your criteria for picking out the higher quality distressed stuff versus some of the others?
Well, in distress, there's kind of two types of due diligence of research. One is the one that you would do for any investment, the macro environment, the business the company is in, the company itself, its financials, the management team, vendors, competitors, all that to sort of paint a picture of what the position the company is. And typically the company is not in a good position, otherwise it wouldn't be distressed. That's one part. And the goal is to say, how much time do they have? Can they survive? Do they have to file? When do they have to file? But the other part that's very specific to distressed is to really do sort of a detective analysis on the capital structure. What are the layers of the capital structure? Who owns what security collateralizes what layer, and therefore who is incentivized to do what to whom in the bankruptcy when sort of the game stops. So it's really a game of risk, if you will, where you position yourself in a layer of the capital structure. Maybe it's the senior secured, maybe it's the subordinated bond, maybe it's the trade claim, maybe you bought some insurance claim from an insurance company that doesn't want to deal with it. Maybe it's the very bottom layer, maybe it's even the equity. That would be rare, but it's possible. And then really a strategic thinking about how that game of risk is going to proceed. And to know that, you just have to go through scenarios, and with experience, you accumulate precedents of how things go. You start really digging into the documents for each piece of debt, and they can vary, and the smallest covenant can make the difference between a losing and a winning trade. And then you position your peons, right? Maybe you have a layered position, maybe you have, a startup position, and you move and you get bigger. That's the work, and that comes with doing it, really.
Right. Well, so what was a trade from that time that you it's just crystallized in your brain of wow, I can't believe I did that, or I was a part of it?
I would think there's a couple. The first one is a trade that went tragically wrong, and I don't know if most investors are like me, but I tend to remember a lot the trades where I lost money.
Oh yeah, that's pretty consistent on here. That's
they're
totally
really searing. But I bought bonds in Welcome at 96 cents on the dollar before they filed for bankruptcy. So the company was already tainted by the CEO, this guy Bernie Ebbers, who was pretty volatile, very eloquent, maybe charismatic, but certainly a character. And he had borrowed some $400 million from the company, which is, I don't think you would do that today. Anyways, so there was already a taint, but certainly nothing else would have indicated that the company was fraudulent. So those bonds were coming due a few months after. So literally, I just had to bite my time for 4 months and get 100 cents on the dollar and call it a victory. Except that one day I go to the dentist for an hour, come back to the office, and the head of research says, "Hey, have you read the news on WorldCom?" I go, "No, what? Did they pay my bond?" Always the positive thinker. They go, "No." He goes, "No, not exactly. Not exactly." I read the headline, and the SEC had started an investigation for fraudulent accounting, and there was a mischarge of some $3 billion. It was something so outrageous that it was game over literally upon reading the subject on Bloomberg, and my bonds had dropped to 20 cents on the dollar.
Oh, geez.
So there you pretty much want to die at that moment, or cry, or just call your mom, to pick you up after school, and just so that that was that was the setup. It turned out to be a fascinating case. It was a really complicated one, but what happened is my partners knew at least part of that business, because part of Welcome was MCI, which had financed itself with bonds through Drexel, and that's where they came from. To make a long story short, we sort of looked at the situation as if we had never looked at it before, and we ended up buying a lot of bonds in the 20 cents area, and a lot of MCI bonds rather than Welcome bonds, and it ended up being a winning trade some years after. I think the bankruptcy took a couple of years. but very much in spite of my initial trade, right? But in the process, it was sort of a concentrate of everything you should know. Don't buy stuff that has low probability but very high consequences in terms of risk. Do re-underwrite a situation when the price has changed radically, and don't lose your nerve if the right situation is to actually buy more at a different price. And that was very much, I was helped by two veterans in distress who could do that.
Absolutely. So, okay. So, catch us up a little bit. So, okay. So you got there at 98. For the first 3 years, you're kind of getting your legs under you, getting your own conviction, building up your own confidence to where you can start to make more of the decisions on your own. So then from 2000, so I guess that's 2001, right? 2001
Correct.
On, what, I mean, I guess from 2001 and then into the financial crisis, I mean, what then happened in this distressed institutional area? Did it just really start to really grow and expand, and then it started to become more competitive?
It did. 01 distressed funds really outperformed. I mean, they were up 20%. So that was a shocker to institutional investors. They took notice, and they took notice also because a man by the name of David Swensen, who was the CIO at Yale, wrote a book about the way he invests Yale's endowment, and it was very much preaching an allocation to alternative managers, meaning hedge funds and private equities. And that triggered the performance, Swensen's influence, which you really can't minimize, and people wanting to make money triggered the growth part of the business. So, every endowment, pension fund, insurance, large company started to think, we should probably have an investment in private equity and hedge funds. And tons of hedge funds just sprang up in different categories. So there was a period of intense growth and very good performance, because again, part of it was there was still tons of bankruptcies for a relatively small universe of people wanting to invest in them. So when there's supply demand imbalance, you have you have some advantages. You have the ability to pick the market and find good stuff. And that went on for a while. And it's interesting because while in 01, distressed and hedge fund clearly outperformed the indices. By 2007, 2008, the hedge fund industry and distressed was already really quite big. And so it didn't outperform. It lost money in 08. It did great in 09 and 2010, but not better than the S&P. And in my mind, and then after that, there was virtually no significant outperformance on a consistent basis. Sure, some years hedge fund outperformed, some hedge funds even outperformed very regularly, but on average, it's very tough to make the claim that hedge funds systematically or consistently or even persistently, if you want to use a statistical term, outperform the market, because at some point they became the market.
Right. Well, okay. So I'm going to go back again real quick, because I just realized there was one question I really wanted to ask there. And it might be a dumb question for those listening who are a bit more technical and understand things even better than me. But so how did the passing of SOX change the distressed industry?
I think it changed in that there's a lot less, at least theoretically, ability to fudge the financials. I'm not sure it changes the distressed more than it changes the investing landscape in general. But it's hopefully it's harder to dupe investors by through fraudulent accounting, which was really in 01, 02, there was a contagion of it.
Yeah, that's for sure. I was just curious. By the way, if SOX is said, it's short for Sarbanes-Oxley for anybody that
correct
doesn't know what the Sarbanes-Oxley Act was, and I encourage everybody to go look it up. It was quite a game changer for the financial industry to say.
I think that you said it right. I think it was a game changer for the financial industry, and Distressed as part of one, was affected by that. I don't know that it was affected more than anything else.
Right. All right. Okay. So now we're going to go back. Okay. Now we're in the GFC area. I mean, so what was that growth process then like for you, from 2001 going through GFC and even up until your retirement, how did you feel like you evolved as an investor? What changed for you? What didn't change?
What changed drastically is that I started having my own portfolio. Of course, like in any company and any hedge fund, the decisions to invest are, you don't make it on your own. But these became my ideas, my portfolio. And I became a portfolio manager, and my great breakthrough really was after September 11, when all the airlines went bankrupt. That's a sector that was assigned to me. And so you can imagine after September 11, virtually all American airlines except Southwest filed for bankruptcy, some very shortly after, like United, some years after, like American Airlines, I think ended up filing in 2005, but they all did. And so those were big capital structures with tons of different pieces of debt, from secured loans to junior bonds, convertible bonds, municipal bonds, and in a very specific area called trust certificates, which are bonds collateralized by aircraft. And nobody had looked at that. So I became the person who does that, and it was incredibly profitable and lucrative, and that was a breakthrough that allowed me to sort of elevate my role, my job as portfolio manager, as somebody who can meet investors and talk about a cool sector, and one that was pretty uncorrelated to the market. So that was really the thing. And after that, the job doesn't change that much, except you have more money to invest. So you need more ideas, and you make more money, which is as a portfolio manager, and you become more of a you have your own business, right? So instead of every day waking up and working on a model for somebody else, you wake up every day thinking, all right, where's my portfolio? Am I balanced enough? Would I rather own Nextel bonds or American Airline, enhanced equipment trust certificate? Should I swap this position for another? What other ideas do I have that I may pursue? So it becomes a very entrepreneurial and creative job. That's the thrill of it.
That just sounds like so much fun. I mean,
it is so fun. It really is an incredibly creative job, is the best word I can think of, because to get a company out of bankruptcy, of course, you need to do the analysis on the financials and the entire puzzle that is a company. But you may need to think about an emergence plan. Maybe there are securities that you need that are kind of bespoke to that business or that situation, because you have to corral all the stakeholders to approve the plan and come out of bankruptcy. And that means, talking to different committees, imagining what they want, finding a in-between solution where nobody's really happy, but nobody's really unhappy, and that's probably the solution that sticks. So it's a very strategic job.
No, I love how you mentioned that it's a lot of the game of risk. Happens to be my favorite board game, by the way. So that's really, you got me there. I was like, all right, maybe I should get into distressed investing right now. But what's it like living in the weird? I mean, flat out, like, what's it like living in the weird of these, strange, weird niche stories? I mean, that, what was it like for you?
Well, it's all encompassing. It's the job itself is, in terms of hours, I came in at 6:30 in the morning, which is when the market opens on the East Coast, and I could leave at 6 p.m. So it's a very regular, job, and I think it's perfect if you have a family, etc. But you live with your positions, right? And it's constantly on your mind. So that's a grind. You're constantly thinking about what your next move is, what somebody else's next move is in the opposite camp, or the guy who's fighting you on the plan. And it's also not something that's particularly interesting at dinner parties, right? So the intricacy of a Puerto Rico bond might be something that you could go on and on for hours about it. It's so interesting. It's so fun to discover that one may have the backing of the US Treasury because it was part of the recovery plan, and one does not. And what clearly recoveries should be different there. But that's not something that's very easy to share with with anybody else. So, I think you shouldn't really. You carry a lot in your head, and it's not something that is particularly riveting to anybody but you and the other guys in the office.
For sure. I mean, and look, you're on a microcap podcast. I'd be remiss if I didn't ask if you didn't I'm sure you came across one or two small micro nano cap stories in the distressed bankruptcy area at the time while you were there.
Yeah, I mean, all those equities after emerging from bankruptcy are in a tough spot because they're illiquid, they're often OTC, and they're owned by mostly creditors. And creditors are not necessarily the best owners of a company in terms of they're the ones that are probably want the cost savings, and they're not looking out for growth because they're so used to sort of tightening the belt because they've got a massive weight of interest expense to face. So, I don't remember anything that sticks in particular, but definitely it's a byproduct of the bankruptcy process for sure.
Got it. All right. So, I'd love to ask about, the culture at Canyon Capital. It sounds like, I mean, for you personally, it sounds like you were ready to get after it no matter what, wherever you were, you wanted to be hooked and you wanted to just learn as much as you can to advance your career. But it sounds like the culture was really one that fostered that curiosity in a sense. What was it like there at Canyon?
It was, at least at the beginning, it was a small place. So it was what you could imagine. Everybody had to do their part. We were mostly, most all decisions or big investments were sort of a make or break one at that size, because one thing's for sure is a small hedge fund is always on the brink of closing, right? You have a few months of bad performance, your anchor investor takes his money out, and you're done. So the first years were very much everyone is rooting for the company to become bigger and stabilize. And then it became more of an institution, a very large company. When I left 3 years ago, it was 25 billion in assets and 250 people. So that changes a lot. There are, like in every place, I imagine, office politics and competition between portfolio managers to get assigned capital. Capital is not infinite, so the more capital you have behind your ideas, the more likely it is that you're going to make a killing. So, you just are constantly fighting for asset allocation for your portfolio, your ideas. So the culture does change, like I imagine, or did change at Canyon, like I imagine it does for every company. But I love the guys who founded the company. Somehow we meshed, we gelled, and it was also a great time to start and stick with it. Frankly, that was more lucky than anything else.
I mean, I'm just so happy to hear that, I mean, look, that's not to say probably it wasn't all positive. I'm sure there was a lot of experiences that you look back on that you're like, it's typical of what women experience in the financial industry. I mean, what, if you don't mind me asking?
Oh yeah, no, right, of course. That doesn't mean that it wasn't lonely and at times extremely tough to be the only woman on the investing side, the only woman who there was a second woman who was made partner later than me, but I was the only female partner for a while, and I was certainly the only female investing partner and portfolio manager. So and that was not specific to Canyon, right? All my 20 years, I met two other female partners. So that just gives you a sense. And what's particularly damning is that it hasn't changed at all. Typically, you would imagine that an industry that becomes more institutionalized, larger, sort of pedestrian type of business becomes more welcoming to different people, or at the very least realizes that we need some fresh blood. Right now, we're very big. It's not clear that our investment team with the 10 white male from Harvard is doing anything different from the next guy who's got 10 Stanford white males, right? So how about we get some fresh ideas, fresh ways of looking at things? And that has not happened. That is, to me, very damning. And not only because I think, hey, it's not fair that women and minorities, but also because it's a wasted opportunity to have a better investment process. I think 1,000%. It was, right? I mean, I think you'd ask 10 people, hey, do you think a diverse team makes better decisions than a non-diverse team within a corporate setting? They would probably all agree that yes, different perspectives lead to better decisions. And that's proven in numerous academic studies. That has not happened by and large, right, in the hedge fund world.
It's really important to bring to light, and I think the more we talk about it, whether it's on podcasts, launching new podcasts that feature more women in finance, I mean, at least for me, that's the only thing that I feel like has helped in some respect. But I mean, there's still just such a long way to go.
I think you're right. And I think that's the reason I wrote the book. It's not because I want to be famous or I want to make money. That is probably the last thing that'll happen. But I wanted to at least show that it's possible to have a very positive experience in a business that's lucrative, that doesn't hurt anything if women start making money or think they can make money. But at least that look, if there's one young woman who's an MBA student or in college taking a finance class who reads my book and thinks, well, that woman seems like a regular, normal person, and she had a great career and she retired before 50, why can't I? Then I have succeeded.
I mean, that's everything right there, right? I mean, I just want this book to be a massive success. I think.
Oh God! Well, I mean, dream on, because the publishing industry is not exactly welcoming of unknown first books, but again,
you got a publicist though. Let's get you that publicist. I mean, look, listen, classic microcap investors, right? Like I'm getting you on before the institutions get you at CNBC and some of the other ones, you know, I mean,
no, but I really appreciate being invited by you, by the other couple guys who and women who reached out, is because I think there is an interest in featuring different people on different paths. So it's and as you said, educating more people on the art and craft of investing. The more we do that, the better.
100%. And not only that, you have another part of your experience that is really beneficial to a lot of women looking into finance and the opportunities in finance. You're also a board member. You're a board director on a number of publicly traded companies, you know? So okay. So you finish at Canyon Capital. I mean, did you think to yourself, okay, my next natural transition is, you know, I want to be a board director? Or did you think to yourself, okay, these are companies that I find very interesting and I think I can add value? And then
I constructively thought, you know, what I would like to do is be on a board, and I love it. I get to give my opinion and do nothing. It's great. I'm just kidding. No, it's so
good.
it's such a different perspective. After being on the investing side for 20 years, I realized how little I could know of the real sausage making of a company. It's really an awakening that it's very hard to know what's going on inside a company, and that you know and I was thinking about again, micro cap, small cap, and I think there's something there, right? Because you can get the management on the phone, and you really can get a very good feel for that business. If you're going to invest in Tesla, what do you know? What do you know more than the next guy, right? It's really such a big picture bet that it almost has very little to do with the company or the job, the work you can do, right? But yeah, being a board member is a fantastic opportunity.
Very good. What as a board member, you know, what are some of the things that you like to contribute in as being on that board? You know, what's from your own experience that you bring to the table there? Like, what's been some of those boardroom conversations like?
I think I'm particularly interested in companies that go through a transition. And by transition, I mostly mean on the capital structure side. So be it, I was on the board of a company called Enworth, which sold to another company called ReadyCap. They're small cap companies, mortgage REITs. So the M&A piece of the deal, I thought I could bring value because I've looked at and done a lot. Obviously, I was on the board of PG&E during its 19 months bankruptcy. I was the audit chair and part of the restructuring committee and the executive committee. There, I think my bankruptcy knowledge was helpful in getting the company out quickly and negotiating with all the parties, bondholders, shareholders, the governor's office, the insurance companies. So I like this. I like to think that my value has a lot to do with changing capital structures or optimizing capital structure, and where I'm frankly learning more than contributing probably is on the operational side, because I've never operated a company before. I mean, I ran my business, my portfolio. I ran the CLO business at Canyon, but these are sort of more financial assets that you move around.
Absolutely. All right. Well, we're now at the question that I love to ask everybody that comes on here, and you've kind of answered it already a little, or you gave one story already, but what would you say was an experience or an investing experience that has impacted you the most in your career?
Uh, Probably Puerto Rico, which was a very fascinating case, and not only because of the scale of it, but mostly because of the political nature of the case. So Puerto Rico filed around 2016, biggest municipal bond issuer, 19 different bond issues, and a territory that was in deep recession for at least 10 years. And it's often the case that a bankruptcy doesn't come, from one day to the next, but after years of sort of neglect and mismanagement. It was that case dragged on, and it's still going on. Actually, there's still no resolution for the general obligations, but it was the one that marked me the most in terms of how do you try to get people around the table to acquiesce on a way out. And when people are acting rationally, meaning for me, rationally is simply to optimize their profit, that's one thing. But when rationally becomes much more, meaning that there is a humanitarian crisis, right? Because people in Puerto Rico don't have schools are closing, hospitals are closing. And when politicians have a rationale on their own, which is to be reelected, then it becomes immensely difficult. And it even maybe then you need to sometimes make decisions that are more for the sake of expediency than really the good of the case. And that, I think that's the one case where I felt I'm just not sure there's a real solution here. So that was it kept me at my job for a few more years than I would have if that case hadn't presented itself, because it was so interesting and new and fascinating. But there were definitely days of deep, dark days where I thought, this is never, the Commonwealth is never going to come out of this. Now I understand at least a few bond issues have emerged and restructured and done well, but the regular general obligations are still in a little bit of a tough spot.
Very good. All right. So before I let you out of here, what advice do you have for new investors, women, everybody? What advice do you have for them looking at the stock market or investing for the first time, or finance in general?
The current stock market, meaning advice as to how to invest their own money, or advice professionally if they want to have a career in finance?
All the above.
Okay. Well, my answer is going to be the same for all the above, which is it's really tough to give such a general advice. And I think, if anything, I'm very wary of self-help books written by hedge funds and other finance experts. I find that the sort of one-stop shopping never works. I tried to read a few of them, and it's sort of never applicable. And it's like Buffett when he says, well, I buy companies with very large moats at a great price. That's great. But that was never my business. I was in the business of buying pretty shitty companies, hopefully for the right price. But I never found a bankrupt company that was great, because it wouldn't have been in bankruptcy. All this to say, I guess the most I could say is stick with it. I find that resilience is a little bit of an underrated quality that really goes a long way, either if you have an investment that's turned sour, or if you're in a 100% male industry where you have a tough time to be heard and have your opinions valued. Sticking with it is usually, and having some sense of humor is a good start.
Very good. All right, Dominique, I think this is a great place to end it. Where can my audience go and find more information about you as well as to pre-order the book?
The book is on pre-order on Amazon, coming out on September 7th. And I'm on Twitter, LinkedIn. I have my website. I have tons of time. So anyone who wants to reach out and have a conversation, I'm here.
Very good. Well, Dominique, thank you so much for joining me today. This was an absolute pleasure. Good luck. Stay safe. And we're neighbors.
We're gonna have
to get together
coffee
soon.
Thank you
definitely.
so much. Thank you for having me.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.